Now, if you're not familiar with this guy's a rock star. PhD, taught at the University of Michigan. After teaching, he got into fund management and stuff like that. And he had this article called Record Extremes, Alternative Investments and the Hippo. I would recommend getting into it, but I do want to gloss over the main points. So he has these sort of warning indicators, scores of overextension flags. And since they're all weak sensors, it's most reliable when a large number of flags, warning flags or compression flags cluster at the same time. And we're seeing a little bit of a cluster here. If we look more closely, he's saying that there's only 4 times in a 40-year history, I believe he said it was, of tracking this, that 55 warning flags kick in a single day. So those, when that happens, that's the red bars. The gray bars shows when it is just more than 32. Seen 6 such days in the past 2 weeks. So the point is that this has only happened a few times in the past 40 years. It includes the dot-com bubble peak as well, just before it, quite some ways before it actually, and a little bit before the 2022 peak that led to a little bit of a bear market, growth scares and all of that, and then the one just before Liberation Day as well. So interesting indicator. Has looked like it has done quite well to flag these types of overextensions. And then the weekly measure also in March has been at 36 the past 2 weeks. No peak is applied, but the extremes may matter for investor risk sentiment. So a little bit more of the same thing there. Our view here, he says, that the massive bubble in tech stocks is only beginning to burst. The recent dot-com plunge merely skimmed away the foam. And we're talking about earnings being so good that it is causing valuations to not be expensive than it would appear as a number, right? If earnings weren't going as strong, and say it took a little bit more of this path rather than a direct up path, then that 45x would probably look a little bit more like 50x or something like that. So this is the starting point. These record earnings is causing PEs to be somewhat contained. These earnings are well over 3 times the historical norm in prior market cycles. And he goes on to say that this is equivalent to saying that at historically normal profit margins in the IT sector, the PE would be well over 135. So if it was to come back and revert to historical normal profit margins, this PE would look very, very expensive, because earnings right now assumes that these record operating profit would continue. One can only take the present multiple of 45 at face value only if one relies on the continuation of record profit margins forever. So that's the key assumption of this market. Obviously, this is not strong enough to say, oh, okay, this is wrong, this is a mispricing, but it's definitely a point to keep in mind. So the moment we get some news that it's not going to be record profits forever, maybe there's more players in the market taking more of that share as a result of the competition. You can no longer command high margins because of competition. Competition will erode those margins away somehow by allowing some of those margins to come down at the expense of gaining more market share and things like that. It's just how it works, right? So it's an interesting point to keep in mind. This section here, it does assume that these companies will be very, very profitable at record profits, maybe even expanding a little bit more for a good bit of time. I don't think there's any reason to argue against that, to be fair. But things can change. Things can get more competitive. Something can happen that disrupts the cycle as well, perhaps somewhere along the way. Maybe a few different AI agents come out that makes compute far more efficient, and then you don't need a heck of a lot of chips. I don't know. But this is the main assumption that I think is the main takeaway from his piece. Just pasting in some of his other comments. Investors are paying valuations that essentially assume the frenzy of spending, revenues, and profits will be sustained year after year forever. Nothing in our investment discipline requires us to rule this out, but it's worth observing that if profit margins are elevated, but may only be elevated for 5 to 10 years, taking the price earnings multiple at face value will give you a strikingly optimistic view of where valuations stand. If profits are unusually high, but only for a limited time, the PE ratio can make the stock look much cheaper than it really is basically what it's saying. Yeah, I mean, there's a lot more detail in this piece, but I just want to cover that main gist. There's stuff like an example of a dentist who sells his stock, Apple stock, and it only takes a short-term shift in market expectations to start to align a different way for a potentially massive amounts of market capitalization to be wiped off. Just a small shift in expectations could amount to a very big sell-off, basically. And of all the biggest stocks and smaller cap stocks, they're all chasing the same theme. Correlation is one. You have a lot of small cap stocks that are related to AI, and as well as the big mega cap stocks with all their AI capex and Nvidias and the chip makers and everything else. Even industrials, right? Their construction equipment, and market is finding all kinds of ways to position for this. So there's a great deal of concentration risk where as a fund manager, he talks about correlation being important because you have to be protected for these risks and not overly exposed. Really gives some good insight into these so-called cheap valuations, perhaps not being all that cheap, right? So, well worth the read, John Hussman. Anytime he has a piece, it's definitely worth reading. So this leaves me with some conversations that I'm having, and every other couple of days, I will catch up with a friend, or I'll get a message or something like that, or whether it's my relatives or something like that. It's always a discussion about what's been doing well and what could do better, and oh, this has been going up so strong, and is it good to chase, and things like that. And that conversation has been going on for a while, and it's been working. But it's still going on to the fact that it's now annoying me a little bit, maybe disturbing me, and I'm just always repeating myself that it's really not the time to really be loading up. And these guys are almost fully invested. It's like they have to talk about what they have to sell to buy something else. They don't really have that extra cash. They're all fully invested. What do you think about the kind of risks that are being faced? It's very difficult to provide a sensible type of advice or support to some of their actions. It's starting to get a little bit kind of crazy, especially when you have to free up capital by selling something to get into something else, some new other opportunities that seem even harder. If that's not bubble-like behavior, I mean, it clearly is, right? So, my reasoning is simple. As you guys will all know, we've gone through this regime where it's all about disinflation and normalizing policy rates. And that's been good for markets, right? If we switch over to our regime indicator, we can see that. And then we have this situation now where we're shifting into inflation going back up. We also have a Strait of Hormuz crisis that is proving difficult to resolve. And my view is that it's very, very difficult to resolve because we've gamed it out. There is no incentive for Iran to really accept Trump's demands. And Trump is at a loss. Time is against him. But at the same time, the deal has to look good for him. So it's very difficult. That means Iran will have to buckle a little bit. Even if Trump buckles a little bit, I don't think it's going to be quite enough. I don't think Iran is going to be quite enough for Iran, knowing that they think that they have leverage, and that's important. They think that they have leverage. Doesn't matter what anyone else thinks, and if they think that, then they'll drag it on longer. So it's important, I think, to understand this regime change, and that's kind of where I'm coming from in terms of what I share. So let's get into the chart with that argument, just to show that we are in that. So, for example, the S&P.